Let's take a look at this David Stockman article. He says the market is pricing perfection for all of eternity. There's just no other way to say it. The market is insanely overvalued right now. The so-called recovery has already lasted 96 months. It's the longest recovery in history. It's also the weakest. But you'd never know it from the stock market. Right now, the S&P is trading at something like 24 times trailing earnings. That is what I would call the nosebleed section of history, and it is absolutely not justified by fundamental economics. The market is pricing itself for perfection for all of eternity. The fact is, the real economy, apart from the canyons of Wall Street, is in very poor shape. The Commerce Department recently reported that the first quarter GDP growth came in at just 0.7%. The report also revealed the slowest first quarter for household spending since 2009. Some economists call that stall speed. After 94 months of the weakest recovery in modern history, there is no way to describe it. We are at the end of a 20-year credit bubble that has basically inflated the world economy beyond any sustainable level. We're now facing the day of reckoning, in which we're going to suffer from a huge deflation for years to come. The global economy is in a place we've never been before. We have never experienced 8 years of effectively zero money market rates, and even during the lowest point of the Depression in the 1930s, we never had a credit bubble in the world economy anything close to what we have now. Yeah, I happen to agree. This credit expansion that we've went through, what happened in 2008 was actually the first contraction. Now, see, they designed the system for exponential growth, and they expected that exponential growth to continue forever. And in order for the system to function properly, exponential growth would have to continue forever. So the exponential growth was continuing in the actual real world market. They were spreading industry to all corners of the earth. They were cutting down forests. They were plowing new roads in. They were doing infrastructure, and everything was expanding. And then in 2008, we got the real world contraction. And it contracted the monetary system as well. And what happened was the whole thing is not designed for that. The monetary system is not designed for a contraction. So what was going to happen is there was going to be a meltdown. Well, they continued to expand the monetary system artificially, but they couldn't expand the real world. They could only expand the monetary system. So what they've been doing ever since is they've been expanding the monetary system, while the real world economy has been contracting. So in order to keep up this Ponzi scheme, which is what it is, it's basically a Ponzi scheme, they had to continue to expand the real world. And China led the charge in this, and they built ghost cities. They did everything that they could. The United States is trying to continue in this policy with infrastructure spending and military spending and so on. Spending. But in reality, it has to reach a point of inflection where it all contracts upon itself. And so the next major contraction is coming. Now, once this next major contraction occurs, and it has to, then what will happen is they will come to the rescue with a monetary, to oppose the contraction with a monetary expansion. So they will inflate the monetary system. Well, what this will do in the end, it'll create this inflation of the monetary system in the end when they come in to try to defeat this contraction is going to create your hyperinflation because confidence then at that point will be lost in the monetary system. Right now, the monetary system is actually on shaky ground, but it's holding together because people love fiat money. Can't put it any other way of putting it. So let's read on here a little bit. It says, in 20 years, central banks have taken their balance sheets from about $2 trillion in 1995 to $21 trillion today. and the global economy is now buried under a $225 trillion mountain of debt, if you can imagine a number that large. I recently came back from a 10-day trip to China, and I can tell you that the world's greatest Ponzi scheme is going to collapse. So put all these things together, and you have a market that's waiting to roll over. Well, I happen to agree with David Stockman. The whole thing is getting ready to roll over. But when it does roll over, what's going to happen is they're going to end it on the other side by doing hyper-monetary stimulus. Now, I've been talking about this for a while, and I might be the first person to actually coin that term of hyper-monetary stimulus. It's different than regular monetary stimulus. Regular monetary stimulus is like quantitative easing. But hyper-monetary stimulus is like quantitative easing on steroids. It's like 10 times greater. And this is what they're going to have to resort to. But when they resort to that, that's what's finally going to push us over the edge into a loss of confidence in the paper currencies. And we're going to see the precipitous drop in the value of the dollar. When that happens, and all of these people who have been hoarding dollars are going to all rush in and try to get rid of them. The same thing can happen with anything. The same thing could happen with Bitcoin. If people lose confidence in Bitcoin, they could all rush in, and then that makes them lose confidence even more if the price were to drop precipitously. If the price were to drop like 30% in one day, or 40% in one day, that would just create more people panicking to come in to try to get rid of them, which would make it even drop more. And so the stampede just creates more problems. Okay, so let's read on. It says bubbles are popping in real estate again. We're also seeing high levels of defaults in student loans and in the auto industry. And one subject I've been following lately is the collapse of the retail industry. I call it the retail apocalypse. Even the Bureau of Labor Statistics seems to have gotten the word about the horrific condition of the malls. During the last few months, it has reported a 60,000 decline in the seasonal maladjusted job count, and a 758,000 drop in the actual count since the December holiday peak. By the way, that compares to only a 644,000 drop in December through March of prior year. Retailers continue to struggle, and dead malls pile up characteristic suburbs across America. Characterless suburbs across America. The plunge in department store sales, which compromise the anchor and driver of 70% of mall traffic. So sales are plunging in retail. Now, I did an article on this just a little while ago, and I talked about the plunging sales in retail. And this is going to continue. This is a trend. Gerald Celente is a trend observer, and this is what he follows as trends. And this is a trend, the plunge in department store sales. This is going to continue. It's going to continue for a point until the collapse occurs. After the collapse is over, then we're going to be looking at, I believe, a surge back into retail again. They're going to, right now, it's a kind of a novelty to be able to buy things online, but people will get tired of it in the end, and they will go back to retail. And the reason why is there's nothing like the experience that you can have making a purchase and actually buying the product in the physical world rather than on some sort of a computer screen. So anyway, this is what's happening now. 15% of sales at department stores have plunged versus last year. It's the largest decline ever recorded. And so this is the thing, that the broad scale markets are about to collide with reality. And I think that we're getting ready to come to a market collapse, but not right away. In the short term, the markets, I think, are going to decline ever so slightly. But then I think they're going to get away with the next interest rate hike. But it's the following interest rate hike, the one after that, that I think that is going to bring things down. And I think the second interest rate coming, so this fall sometime, when the next interest rate after this interest rate they're going to have now, the next one after that, that's the one that's going to bring the Fed down, I believe. And it's going to bring the market into a serious correction. And it's going to force the Fed's hand to reverse their policy. And when they reverse policy and they really get in earnest into the next phase of money creation, that's when confidence is going to start to be lost in the dollar. So thank you very much for listening. Like and subscribe, and we'll catch you in the next article. Bye.